celebrating 25 years. What has been your biggest hits and misses, if you look back, of HDFC Securities? And secondly, bank-based, bank-owned brokerages like you had a distinct advantage before this pre-pandemic boom in the broking business. But the new age companies, the discount brokers took, basically they gained gained more than brokerages like yours. So what really are the takeaways from that? And going forward, how do you see your business? Will the focus be on generating more revenues, or by targeting high net worth clients, or are you going to focus more on adding more clients? Yeah.
So Sundar, you've asked me all possible questions on the broking industry in just one question only. Thank you for that. I'll take first the last question. Segments we'll focus on. I think we will focus on all possible segments, and we believe that we have digital properties, expertise, and also understanding of all the segments in place. We have been full service brokerage house. So we'll continue to put our trust on full service brokerage house through our brick and mortar ecosystem as well as through our digital properties. I can tell you that we've seen a lot of disruption coming in from the discount brokerage houses, but despite this disruption, we've seen that customers have progressed very well with us. They have shown their trust, their confidence, and they are aligned the way we operate and help them in their wealth creation journey with us. That's how they have been with us through and through in these last 25 years and growing also. So we'll continue to focus on full service brokerage house. At the same time, we do acknowledge that the tech-led discount brokers have done tremendous job in democratizing the making investments and making it accessible at lower cost. And there are certain set of customers who are price sensitive, cost sensitive, and also own a lot more digital savvy and are only looking at digital properties to help them in executing their decisions. And that's where we've launched HDFC Sky, and we believe that we will disrupt the disruptors with HDFC Sky application. And we've already acquired in last 15 months more than 1.8 million customers in HDFC Sky, and we'll continue to acquire more customers. Our thrust is always to add value to our customers. Even in HDFC Sky, which is a discount broking platform, we do offer research. HDFC Securities in-house research, captive research is offered to all discount broking customers also. At the same time, we do have a product like margin trade facility also available for all our customers in HDFC Sky also. We realize that there is a niche space on advisory side where customers are looking forward for advisory services, and that's where very recently we've launched HDFC True, our advisory services. Just about 7-8 months ago, I think in this room only we've launched. Some of you were there at that launch event also. In last 7-8 months, we could able to grow our AUM, asset under advice, to over 10,000 crores. We believe it's a very niche space and it requires a lot of expertise, honesty. We'll build this business brick by brick and try to make this as a business that will act as a benchmark for not only industry in India but also globally. So we'll continue to focus on all possible segments. Regarding your first question, Sundar, on takeaways from the last 25 years or learnings in last 25 years, I think the biggest takeaway is that the transaction-oriented businesses are up for disruption, something we have seen in the broking space and also in the payment space also. If you see in the payment space, there are fintech players who have disrupted despite banks are also offering all possible payment services. However, it is difficult to disrupt the fund-based activities as hardly any fintech player is able to form a significant disruption in the fund-based activities. So this is one learning. Other thing is that our takeaways are that the customers are really looking forward in mid to long run a value addition coming in from the partners or brokerage houses or distributors. So that's where we believe that they may have a consideration on cost for the some time, but at the end of the day, in mid to long term, all that they value is what kind of a value additions are coming from their partner entity, and whether it is in the form of digital properties, real-time insights through the innovative method of engaging and connecting with them, or also through the active relationship management also. Most of our customers are still skeptical about where to invest, when to invest, how to book profits, what kind of asset allocation they should have, what kind of diversification they should achieve. You know that asset classes like gold have done so very well. India have been investing into the gold in physical form, and off late in last 10 years with the advent of gold ETFs and sovereign gold bond, Indians have taken exposure into the some of these asset classes through different products also. I mentioned in my address that portfolio management services and alternative investment funds and even unlisteds have got the fancy or attraction of many of our customers. So cutting long story short, I strongly believe that there is a significant room for us to add value and differentiated value to our customers, and we'll continue to focus on the same.
Hello, good afternoon. I am Mehul Dani from FinTech Biz News. What are your insights with regard to FPIs and high net worth individuals? Secondly, how well you have been able to deploy the technologies, specifically customer-facing technologies, which act as a market differentiators for your company? Thank you.
Again, I'll take second question first. I think we take a lot of pride in innovation and bringing in the best-in-class technology, digital properties for our customers. Our InvestRight application is one of the best applications. It's rated 4.5 plus on App Store and Play Store, and it is loaded with the features. I would humbly request you to go through the application, open an account with us, or otherwise see the application. It brings in all possible asset classes. Customer can just start the journey in 5-7 minutes only, and after that it's very easy for them to invest in direct equity, derivatives, mutual funds, and all other products that are available on the application. We also have a portfolio which takes care of the corporate actions. We have features like XIRR, where customers can get to know about their annualized returns. So we have almost everything available to them. We do provide real-time insight to our customer through the in-app notifications, emails, and also through the price alerts mechanism. We have inbuilt strategies in the derivatives for the customers so that they can take informed call. They can know well in advance that what kind of profits they can make in particular trade and what kind of possible losses can be there also. Similarly, we have bracket order, basket order, and many more features that help customer to manage their portfolios, manage their investments and transactions very well. And all these features and more are there on HDFC Sky also. In HDFC Sky, we have, we do have also commodities available to them also. Very soon we will launch the same in InvestRight application also. And also they can invest into global stocks through a partner relationship. We have partnered with the couple of fintechs to offer global stocks. Customers with this same convenience can invest in Indian equities and Indian financial products as much as they can invest into all possible stocks that are listed on US, ETFs, and many more products. Your first question was on the FPI side and the HNI side. I think HNI side, we've seen a significant resilience and evolution in their understanding. I've been in this industry for last 25 years. In early 2000, around 2008, there were a lot of skepticism. People would panic when there are market corrections. So behaviorally, people HNIs have evolved significantly. Their risk appetites have also increased. They have learned the way to navigate the volatility in last 20-25 years. And today they have understood that they will sink and swim with the market, and they are willing to do that. They are not panicking when there are corrections in the market. In fact, they are always keeping their powder dry to use these kind of opportunities to invest more whenever there are significant corrections or some events in the markets, whereby they strongly believe that they may have a short-term negative impact, but long-term it will help them to create their wealth also. They've also got a lot more understanding about the stocks, portfolios, and mutual funds, and many more products also. So today we face a lot of intelligent questions from our customers also. They are no more just looking at the recommendation, they are also looking at why are you recommending this particular company, and why do you believe this company will do well, why this stock will do well, and what valuations are there, what is their business model. So there are a lot of engagements happening on that front. As far as FPIs are concerned, I think they have been a pillar in the Indian capital market story, and they've been investing in quality companies, and our take is that they will continue to find India as an attractive destination to invest. Unlike Indians, where the liquidity is married to the Indian markets largely, and very limited liquidity goes to the overseas investments through LRS route, FPIs have multiple options available to them. They can invest into any markets, they can invest into the different asset classes also. So from time to time, they continue to take their decisions on which markets are more attractive, and that's how, or which products are more attractive, where they see more risk reward favorable, that's where they invest. But in short term, last year we've seen them taking out a lot of money from Indian markets. Recently they've started to invest more. I believe that it's hard to bet against India.
Hi, I'm Dipti from Mint. So my question is to Dhiraj and Varun sir. Given the market decline today, do you think it's closely linked to the India-Pakistan escalating tensions? Also, from a slightly medium-term perspective, where do you think India is placed? Do you think that money would flow from the US into Indian markets along with maybe other markets like Japan? What's your perspective?
See, I'll break my answer into two, Vipti, that one, in the long run, markets are slaves of earnings. We are all aware of that. In short term, there could be an impact because of the market conditions. There could be impact of geopolitical conditions or maybe across border activities. So to that extent, it may have its own negative impacts on the markets, and we may witness more volatility. But I think in the long term or mid term, we believe India growth story is absolutely intact, and all possible high frequency indicators like GST collections, direct taxes collections, in fact, projection of IMD on more than normal monsoon, 105% of the long-term average. All these are favorable indicators. In fact, we have managed the inflation also very well. Inflation currently is now below the RBI expected number, and to that extent leaves some room for the rate cuts. We've witnessed 50 basis rate cut in the last few months, and we believe that we are fundamentally strong. Of course, in mid-term, short-term, if there are escalations, it will have its own impact on the markets. Varun, if you want to add more.
Yeah, I think just to add, not much to read into one-day movement. If you look at, in 3 weeks, not even 3 weeks, probably 2 weeks, we are up 10% from the low which we had made on the tariff announcement day. So, the rally was very sharp because risk reward was starting to get attractive in certain pockets. And what we have been saying anyway, at the start of the year we were cautious on the full year outlook, given how valuations were looking stretched in a lot of mid and small caps in particular, and we saw a fair bit of correction in the first quarter, Jan to March. There was a very sharp correction. These days typically the movements have become very sharp because of the information asymmetry not being there, and after that correction in April we have seen things picking up, and even in terms of earnings, and what we said at the end of March was that probably now is not a time to be overly bearish on equities. I think the time to be slightly more cautious and bearish was last year when things were looking too stretched. But now in terms of earnings, while we may still continue to see some downgrades, the pace of downgrades won't be as sharp in FY26. Secondly, on flows, I think FPI outflows also you will start to see that number sort of stabilizing. So last year we have seen a lot of FPI outflows. We did one analysis where historically FPIs have not sold to this quantum for more than 2 consecutive quarters, barring GFC, which was way back in 2008 when the actual event was really big. I think if I take that out, then the extent of selling we have seen from FPIs in the last 2 quarters more or less makes us believe that we are at the fag end of FPI selling. Now that doesn't mean that they will jump in and buy very aggressively. I think that will be a case of how relative valuations look. Certain other economies are still more attractive on that basis, but the medium to long term growth prospects of Indian economy are still one of the better ones. When we talk to FPIs, we don't see them concerned on that aspect. So therefore, again, FPI flows, you have to look at it in 2 buckets. One is, the really sticky long-term money. Out there, we have not seen any change of views, and they continue to happily hold India in their portfolios. Second is the more tactical, hot money, as we call it, which would be, trying to take that 10% sort of moves in various markets, and that tends to be volatile. That money still may not find India too attractive in the relative scheme of things, and therefore aggregate FPI inflows may still be muted, but it would be much better than FY25. So in a nutshell, macroeconomic parameters, earnings, valuation and flows, all 4 at the margin are looking better for FY26 compared to what they were in FY25. But at the same time, none of them are so strong that one should get overly bullish on equities. But we believe there is nothing to be bearish on equities. One should maintain their asset allocation. On dips, one should look to buy. The medium to long term fundamentals are still strong. We are able to find enough good ideas after this round of correction. So we are continuing to work out with that kind of a view.
Actually, I have a follow-up. So if tensions with Pakistan heat up a little more than what it is today, do you think it would be a big bother for markets?
Not really. See, if you look at, will it really impact earnings? Because as Dhiraj said, ultimately markets tend to get impacted only when earnings take a beating. Frankly, we have had these kind of issues in the past also. In the in the last 5 years, we have had 1 or 2 such instances. In fact, whenever the reasons are something which are not related to real fundamentals, they tend to get sorted really soon. Tariffs is again one example. While that still would have impact on earnings in our view, India-Pakistan thing has very limited impact on earnings. So these are more sentiment things which tend to impact some of the money at the margin. Some of the retail money which just came into the market, they tend to get worried when these kind of events happen. But frankly, we see this as a non-event from a market perspective, from a medium term. 5-7% corrections here and there or up moves can happen at any point because of sentiments. But for anything sustainable or bigger than that, it has to be backed by a real earnings impact.
Hi, so this is Anisha from Money Control. I have couple of questions with regards to the report. So one thing I've seen is that you don't have any private banking names in the thing. I mean, BFSI is a very small, a few names you have. I mean, you have State Bank, which is obviously PSU, that's there, but you don't have any private bank names over there. So is there any particular reason for that? And I'll ask you.
Not really. See, as I said, the idea was not to have a equal representation or something what the index has. So BFSI, as you see, is around 16% weight, which is much lower than what Nifty has, but it is more in sync with what say BSE 200 has in terms of the BFSI weighting. And like we continue to be positive on quite a few private sector banks, like ICICI, is one of our top picks. Even Axis we have in our model portfolio. But the idea was not to own 40% bank, because then it becomes a tactical thing that the moment we get slightly negative on banks for whatever reason. This is a portfolio which is a medium term buy and hold. SBI we believe is doing as well as any of the private banks on most parameters, and is in terms of valuation it is at a fairly good discount to some of the private banks. So while ROA is lower than that, the valuation discount is even steeper. So we believe SBI provides you a good alternative to kind of play the banking story. So, but nothing against private banks. We are overall positive on them as well.
And I also wanted to ask you, I mean, you have a pretty much equal number of, large cap and mid cap funds that are there. And also in terms of investor interest also is pretty much still there within the small and mid cap space. So has the skepticism or the concern regarding small and mid caps, has that gone away? Because even if you see shareholding and all that stuff, investors are looking to invest into small and mid cap majority. So how do you view that?
So see, at the start of the year when we did meet, we were cautious on small and mid cap, and what we said in our model portfolio, almost 65 to 70% we were in large caps and only 30% was in small and mid caps. Even though we knew that small and mid cap correction would happen, we didn't sell those 25-30% holding which we had in small and mid cap. And the reason is, when one is looking from a 3 to 5 year perspective, it's sort of absolutely necessary for wealth creation that you need to have certain good small and mid caps names in your portfolio, because they tend to outgrow the large caps in terms of earnings if they are well run, right? Because of the lower base, their ability to grow is higher. So first of all, we were never in the camp that small and mid cap should not be a part of the portfolio. We believe they should always be a part of any portfolio which has a slightly longer the time horizon, longer should be the proportion of small and mid caps in your portfolio. But at the same time, in small and mid cap, it's very, very bottom up and stock specific. So what stocks you hold is of paramount importance. Like if you are stuck in the wrong stocks, they can fall 80-90% and never come back. So therefore, I think small and mid cap investing has to be done by experts and people who know those companies in and out. Compared to that start of the year, after this correction in Jan to March, definitely we believe a lot of the small and mid caps, I would not say that they have become dirt cheap or very attractive, but I think a lot of the mid cap and small caps have seen a good healthy correction, and from here on we are seeing good positive risk reward. Like just to give an example, in December end, if we were finding only 10% of our mid and small cap universe as worth investing, today at least 40 to 50% of those have come to a point where we are getting positive and we are happy to invest in them from a 3-year kind of a perspective. So with that context, in this portfolio, almost the large cap and mid cap is 55-45. So in that sense, we have increased our mid and small cap sort of holding compared to what it was in the beginning of the year, and we believe that should be the case given the correction which has happened. It's still, I would say, if it was a COVID kind of a correction when small and mid caps had become really attractive, then probably it should have been more like 60-65%. We are not there yet. But if there is one more round of correction in some of these small and mid caps, and we find more ideas, we'll be happy to increase it further.
Sir, what is your current market share in the brokerage space and how do you propose to enhance it in the current FY?
So, different segments have a different market share. We've always been focusing on wealth creation of our customers. In retail segment, cash segment, we have double-digit market share. As I mentioned some time ago, in the margin trade facility, we have double-digit market share. In derivatives, we've not been actively working on that space, so we have a lower market share. Having said that, through HDFC Sky, now we are looking forward to gain more market share in the derivatives also. I think we don't focus so much only on gaining market share. Our thrust is always to add value to our customers, and market share and revenue are byproduct of our engagement and our advice and our recommendations to our customers.
My question is to Mr. Varun. Sectoral leadership was one of the criteria for the 25 stocks. So have you also considered the players within the listed space who could become challengers, potential to become challengers to these sectoral leaders, or come as a number two?
Correct. So as I said very clearly in that presentation, that so we have chosen some sector leaders where we believe their leadership or their sector leadership will not get challenged to a large extent in the next 3 to 5 years compared to how things were, say, in the last few years. So that's one. But at the same time, we are always looking for challenger companies who can outgrow, the industry and gain market share. And therefore, a lot of these mid and small caps fall in that bucket which we have chosen. Some of them are there in large sectors with a small market share, and we are, given our expectations bottom up on some of those companies, we believe they will be gaining market share, and that's reflected in much higher earning growth for those companies. And in certain cases, we may not have, they might be a sector leader, but they are in a sector which itself is small, so they are mid and small cap, but they are sector leaders, in their own respective subsectors. So a lot of the stocks you will find it that way. So therefore, while they may be, looking like mid and small caps, they are sector leaders, and therefore if I do an aggregate of how many of these stocks are sector leaders in their respective subsectors, it would be a much higher number than those 6 or 7 stocks, mega large caps, which you are seeing as sector leaders. So, idea is to have a combination of both. But what we have seen is, if a sector leader kind of continues to execute well, there is a natural tendency for them to gain share. The big keeps getting bigger in most of the sectors because of the better resources, better capital allocation, better ability to attract talent, and therefore, in a growing economy, a sector leader, because it's not like the West where the industries are not growing at all, and therefore you need to look at more challenger names to get that extra growth. In India, even a sector leader, if he is managing the business well, can continue to grow in double digits easily. Then it makes a lot more sense to be with a sector leader, in those spaces if they will, continue to grow double digit. So it's a good mix of having sector leaders in the portfolio, at the same time having some companies where there are some bottom-up reasons why next 2 or 3 years, given their plans, they can outgrow the industry and gain some market share. So it's a combination of both.
One more thing, does sectoral leadership guarantee that the stocks or wealth creation through stocks, because considering a lot of PSU names are sectoral leaders, but the stocks don't give that kind of returns.
Again,
so how does one navigate this?
So that's why you see, we have got sector leaders, but we have to look at their earning growth. So if they're a sector leader with a 5% earning growth, which means maybe the sector itself doesn't grow very high. Some of the oil and gas PSUs or some of the other, PSUs may fall into that bucket. So we have not kept those in our, so the idea is not to choose every sector leader. The idea is to choose sector leaders which meet those 2 or 3 additional criteria, which is one, we should be confident that they will continue to maintain their sector leadership 3 or 5 years out. Secondly, the industry or the sector they are in has to have a growth which is respectable enough for us to get a double digit minimum earning growth for you to kind of to invest in those. Otherwise there is no point in being a sector leader with a flat or a very low growth. So therefore you will see that a lot of the sectors we have not picked sector leaders. So it's not that in every sector we have gone and picked sector leaders. So it's very cherry picked in that sense.
So, my question is for Ms. Bhatia. Ma'am, can you share a little about the initiative of Know Your Money? I'd like to know about the timeline, the response for it so far, and you've aimed to impact the lives of 25 million people. So I just want to know if there's also any conversation about including AI as part of the financial literacy in that initiative.
Okay, so so far what we've done is we've started at a small scale. So we started with schools in Maharashtra, and as we shared the number, Ashish had shared the numbers, we've been able to reach out to 100,000 people at this point of time. With the launch of the mobile app, that's the entire objective, saying through a digital app, we would want to reach out at a much larger scale, and that is where we will use both the digital abilities and our expertise in terms of being able to demystify, make it simple, make financial complex simple for them. So that is the way we would want to look at it. AI at this point of time, we are not targeting, at least in this year, because as I said, this year the focus will be a lot more on making the content simple and making the content very interactive. So we're taking that first step in terms of helping the segment really understand what is finance, how do you start your savings, how do you start making financial goals, etc. So probably AI, I think it's a good idea. Probably next year when we've reached a certain scale, we can see how we can leverage that.
Thank you, thank you.
My name is Ayush and I'm from Finite Media. I have a question about how do you find those stocks, for example, Airtel or Avenue Supermart, which are in their recent times, they were not posing threats to larger stocks, but currently they are actually in a big hub. So at their starting period of time, so like how do you figure out those types of stocks which are actually going to pose a big threat into the on the like large companies?
So see,
and keep it in your portfolio.
So the portfolios obviously have to be dynamic and have to be evaluated. Obviously we do evaluate our model portfolios every quarter, and every retail investors we believe should also be doing at least, if not quarter, then 6 monthly, because a lot of things keep changing, which actually changes your investment thesis at times, and therefore you need to respond to those changes. I think as I said, say Bharti Airtel, classic example, market leader. It was the market leader even earlier, but it was going through a period when the industry was going through tough times, but they maintained their sector leadership, and valuations were quite attractive then. So it made a lot of sense for anybody to own Bharti Airtel, and we also had it in our model portfolio for a long period of time. Now, just to give you an example, it's not part today of this 25 list, because now we believe a lot of those positives have been discounted and valuations are on the higher side. So as I said, in large caps, we tend to look at valuations very closely, because some of those sectors we know will not keep growing at a very high pace, even sort of the fact that some of those companies are really big and therefore the growth rates are more or less predictable. But when valuations go really off the charts, sometimes because of those companies doing well in the recent past, we tend to avoid those large caps and we tend to wait for better entry opportunities in those quality business. So Airtel is like in that camp right now, where we believe valuations are run up slightly ahead. In case of DMart, again, valuations was a big issue for us to not own the stock for the last 3 to 4 years. In fact, we didn't have a positive rating because of valuations, even though then other issues also came by in terms of quick commerce impacting them. So it's like competition is another variable which you have to keep in mind when picking these stocks, that these days you don't know where and how competition comes and hits you, and therefore buying stocks with a valuation or a margin of safety comfort becomes very paramount, because while today they might be market leaders and they might be very strong, you never know how a new competitor comes in and starts disrupting them. So you have to be very conscious of some of these things, and at the same time be very conscious of valuation that you are paying, because if you are stuck even in a good quality stock at the wrong valuations, there might be a decade when you make zero money. Just in case of say Bharti, 2007 to 2017 it gave you zero return. In case of Unilever, 2000 to 2010 it gave you zero return. Now again Unilever 2020 to 2025 has given you zero return. Not to say they are not sector leaders, not to say they are not great companies, but it's just that you bought them at the wrong price. So it's a combination of growth, valuations, quality, everything has to kind of fit in together, and you will still go wrong, and that's where you need to keep reviewing the portfolio and make sure that if things have changed on the ground, if anything has changed to challenge your investment thesis, then you make those changes in the portfolio.
Hi, Anjana from Informist here. My question is regarding, sir, first of all, congratulations on your journey. My question is about the derivatives segment. SEBI has been increasingly tightening its norms in the F&O space, right? So my question is, sir, throughout this journey, you have had your fair share of learning, as Mr. Dhiraj said. What are the risks or challenges as a service provider that you see in the derivative space, and what needs to change, whether it be in terms of financial literacy, whether it be in terms of regulation? What are the things that should improve, or what are the things that should change?
I think in last few years we've seen exponential growth in the derivative as a segment in India. I mentioned that NSE is the #1 stock exchange in the world in derivatives. There were exuberance. Many new investors, particularly young investors, were coming to the market and trying to make money in short term, and they were speculating in the market without understanding the derivatives. There were more than required expiries in the that is leading into more and more speculation also. So SEBI has made some right interventions to ensure that we can deal with the exuberance in the derivative space. There's a lot of work to be done by regulators, exchanges, us, you guys, to ensure that we educate customers, we inform them that what kind of risk they carry in some of these transactions, particularly when you are not aware that it can lead to a significant capital erosion. Then it is very important that we educate our customers well. So we've been very, very conservative in this space. Unlike other brokerage houses where it's 70 to 85% of their revenue comes from derivative, for us it's just about 15% of our brokerage revenue comes from a derivative space. So we have been prudent. The other things what can be done is to do a suitability exercise when you are onboarding customer for derivatives. Like when you are allowed to drive, you need to go through a driving license. Similarly, a suitability exercise, a simple suitability exercise can be done. It could mean basically that they should have a somewhat understanding of the product. They can go through a basic certifications, or they have adequate experience in the market. Some of those things can be done, maybe on the anvil also. But as of now, whatever interventions are done, I think they are good enough to deal with the exuberance in the derivative space.
Thank you.
Hi, I'm Akshita from the Hindu Business Line. Building on what she said, and like you said, derivatives is not a huge portion of your revenue. But as a whole, the broking industry has struggled a little with pressures on margin and volumes from these F&O rules, which, while warranted, have impacted. So, how do you see brokers to be able to manage this pressure from reduced volumes? Like if Ashish sir or Dhiraj sir could help me with this.
So, if you look at the particularly the regulatory changes which has happened, I think so over the past few days, and the derivatives was one of them. I think the true to label was also an equal factor wherein basis volumes brokers were getting advantage of the discount which was passed on by the exchanges to the brokers. And the third one, which I think so was not noticed by the media also, is the basic demat services account, which I think so, which the limit was raised up to 10 lakh rupees. And the brokers actually on the AMC can charge only up to 100 rupees. So that also led to some 25 to 30% reduction in the income on the demat services. Obviously, derivatives has its own share of volume reduction, plus the true to label, which also had an effect on the bottom line for the brokers. Now to navigate all this, 2-3 things brokers can do. I mean, the simplest one is to increase the charges, which I think so, if you look at in bits and pieces, while the charges have remained 20 rupees per order largely, but however some of the brokers have, which were not charging on delivery, have started charging 20 rupees per order, plus you have a percentage or 20 whichever is higher, so then that percentages have changed. So in bits and pieces, some of the brokers somewhere have started increasing the charges, but in the long run, if the pressures remain, and see if the markets were to improve, volumes were to improve, I think so everything can be done. But however, in the larger space of things, to retain the margin, I think so somewhere someone will start making a move to increase the charges. That remains the only option, because brokerage finally it's a fee income. It's not a, I mean, you build a book like a funding book and keep earning. So it's not an AUM business. Brokerage is like a daily transaction business. So one of the options is to increase the charges for brokers. Second option is, I mean, not much, but yes, the brokers can look at some cross-selling or a distribution model which can yield them some kind of revenue. So this is what we feel.
Sorry. I'm afraid it's all the time we have for today. Thank you so much to our leadership. Thank you to all the members of the media for your thoughtful questions and for being part of this milestone event. On behalf of HDFC Securities, I extend our heartfelt gratitude for your continued support and partnership over the past 25 years. We invite you to join us for lunch and networking, where you can interact further with our leaders.